Welcome to HomeCapital's series on home ownership. Buying your first house can be a daunting task, and in this series, we simplify the entire process for you. In this series, we will talk about the various factors you must consider before buying a house, the process that you will run through when you are buying a house and taking a home loan against it, and finally, what your responsibilities are as a homeowner. In today's episode, we will talk about understanding the various aspects of a home loan. Given that the home purchase is a very high ticket purchase, it is very common to use the assistance of a home loan in order to fulfill your dream of buying a house. In this episode, we will talk about the various sources of getting a home loan. We will talk about the various aspects or features of a home loan, the entire process that you need to go through when you are applying for a home loan, the loan dispersal process, and finally the government schemes available in case of buying a affordable home. Let's start with the various sources from whom you can procure a home loan. The most common place to apply for a home loan is our banks, where we also get our other loans other than a home loan. Banks are governed by RBI, and just like any other loan, they are also an institution who would sanction a home loan to you. The next option for applying for a home loan are what are known as HFCs or housing finance companies. A housing finance company is basically a NBFC or a non-banking finance company which is into financing homes for their purchase or construction. In addition to a bank or a HFC, which are the formal sources of getting a loan, you can always procure a loan from your friends and family as well. Banks use the money deposited by their customers in their current accounts and savings accounts, which are also known as CASA accounts, to fund their lending of home loans. It is the same money which we deposit with the banks that they give it back to us as a loan or in the form of a home loan. A HFC or a housing finance company would fund their loans by raising money from the public or borrowing it from the other banks. Since a housing finance company borrows money from banks, the cost of funding for them is higher, and as a result, the rate at which they lend the loan is also higher when compared to a bank. With respect to the loans given by your friends and family, it is generally funded from their life savings. If there is somebody in your friend circle or among your families who has saved a decent amount of money, they may be willing to lend it to you for helping you fulfill your dream of buying the house. Once we understand the sources of funding of home loans by the bank or the HFC, let's understand how the interest rate is computed by them. Banks use the MCLR, or what is known as the marginal cost of funds based lending rate, to arrive at the interest rate at which they are going to lend the home loan to you. So the rate at which the home loan is given to you is calculated as the MCLR rate plus a spread. A spread is basically the additional amount over and above the MCLR rate the bank is going to charge you. The spread is determined by the tenure for which the loan is given to you, and also is determined by how risky the bank perceives giving a loan to you. So if you are considered as a good borrower, somebody who has a good credit score and a good credit history, the spread for you would be lesser compared to somebody who does not have a very good credit history. So the rate at which the bank would lend to you would be determined as the MCLR rate plus the spread the bank wants to earn, which is determined based on the risk they perceive when they lend the money to you. With respect to a housing finance company, the interest rate is determined by arriving at a discount percentage to their PLR. A PLR is nothing but the prime lending rate. The prime lending rate is the maximum interest rate a HFC can charge to its borrowers. From this PLR, an HFC would give you a certain discount based on the risk they perceive for giving a loan to you as a home buyer. So if you are a good borrower or if you are considered somebody with a good history, you can expect a higher discount rate versus if you are a riskier borrower, you will land up with a lower discount rate. Once your discount rate is determined, the interest at which you will be given the home loan is equal to the PLR rate, that is your prime lending rate, minus the discount rate. Now, whether you choose to borrow from a bank or a HFC is a function of your status as a borrower and also your requirements in terms of the amount that you need and the project that you need it for. Generally, the rate at which a bank would lend you a home loan would be lower than the rate at which a HFC would give you the home loan. Having said that, the banks are extremely stringent in their processing of home loans, and as a result of which, when you are not able to qualify for a home loan with a bank or not able to qualify for the quantum that you need a home loan, you move on to a HFC or a housing finance company who are more flexible when dealing with applications for home loans and also who are ready to take on that additional risk to deal with certain set of borrowers who are rejected by the banks. The HomeCapital community assists and guides you successfully through your journey of home ownership. Join India's first community of home buyers and home owners and take your next step towards home ownership.